Everyone, David Coe, the Coe Real Estate Group. As we like to do on our show here is talk about things that affect close of escrow, either before or after close of escrow. And today I've got my good friend Ben Levine here. We're actually going to talk about something that, well, I guess kind of happens both before and after close of escrow. We're going to talk about a way to mitigate your capital gains taxes if you are someone who owns a home, wants to sell it, but has a large gain that you want to try to find a way to mitigate that. So, Ben, thank you for spending some time today.
Awesome. Thanks, Dave. Love being here and looking forward to chatting. Just to tell you briefly about myself, I'm the president of DST Advisors. We are in Calabasas, California. We are an authorized trustee for the law firm that creates the Deferred Sales Trust structure. My business partner is a CPA. He's a practicing CPA that's been in business for 40 years. We've both been around for a while. And, we help people defer capital gains tax, keep more of their wealth longer. It's a structure that's been around for 25 years. Actually, the base code has been around for a lot longer than that, which I can talk about. But yeah, it's good stuff. We love what we do and enjoy working with people like yourself.
Yeah, I mean, I heard you speak a couple of weeks ago, and while I've heard about your kind of DST, I think you did such a great job of kind of walking people through why it's a good thing for some people and why it's not good for other people. It's another option when you're talking about how to defer taxes. So thanks for coming on today and sharing some of that. Let's kind of start off with the whole idea of a DST versus a TST. And a lot of people may not understand that, but there are really two DSTs to help mitigate, these capital gain taxes. So why don't you talk about how you're different, what you do versus a Delaware statutory trust?
Great. Yeah, that's it's fortunate and unfortunate that we have the same acronym because we get confused.
That's marketing. Whoever did that should have come up with something different, just to have a point of differentiation.
Exactly. I think ours has been around longer, but I'm not sure. I know our structure has been around for over 25 years, created by a law firm and CPA firm, 25 plus years ago. I don't really know how long the Delaware structure has been around, but unfortunately or fortunately, they have the same acronym and often get confused. But there are some distinct differences that people, need to know about. And I'm not saying that the Delaware or the Deferred Sales Trust is any better than any of the others, right? It's just it always starts with what are the goals of the client? Why is the seller selling this asset? What are they trying to achieve, right? And based upon those goals, then the advisors can help them find the right solution. So our solution is great for a lot of people, and it's not good for certain people. Some of the big differences are, in the Delaware, there's typically a set or estimated return that they anticipate. The whole structure is kind of a black box, and it's really a purely passive type of investment, right? You really have no input and no say on anything, which a lot of people love, right? They're trying to simplify life. Hey, I don't want to be thinking about that stuff. Just send me my check every month and I'm cool. So, that works great. And for certain people that are only comfortable maybe with real estate. So they might be selling a piece of real estate, but they like that asset class and want to stay in it. So those are people that should really consider the Delaware structure. And we use the Delaware structure for part of our deals sometimes. So I definitely don't want to poo-poo it, but there are some differences. With our structure, there's a lot more flexibility. People can design their payment schedule. So instead of just, the fund saying you're going to get a 4.5% return every month, in our case, they're designing how much they want to take. They also have oversight on how the investments are made. So, if it's somebody where the proceeds come into the trust and they're more aggressive, they have a longer timeline, they're comfortable taking more risk, they can get a much higher return than they might get in a Delaware, right? So.
And really, the Delaware Trust is really more like a syndication investment, right? It just has special tax purposes. So I always think of the Delaware situation almost just like a syndication that has the ability for people to 1031 exchange into it. But you can't sell your personal home and then invest that a Delaware
Right.
statutory trust, correct? It has to be an investment property.
That's an important point, right? You can't do that because you can't do an exchange, and the Delaware is a type of exchange. So you can't do a 1031 exchange with your personal residence, but with our structure you can, which is one of the distinct differences. We just did several, homes for people in the last 60 days that actually left LA and moved to Spain, which is kind of cool. But we've also done some very
Spain, Portugal, and I forget the third country. I think it might actually be Australia. Almost a 150% increase in American expats that have been moving to those three
Is
countries in
that right?
the
Wow.
last year.
Yeah.
Yeah.
Yeah, it's interesting. And that's the cool part. I love like this technology where you can be on Zoom with a client and they're in Spain or Australia and we're here and in SoCal and all looking at the same thing. So it really has opened up business, which I love. But yeah, we've done some very, very big homes in places like Montecito and Bel Air where people have very big profits. 10 plus $1 million, $20 million, and the 250 or $500,000 exclusion doesn't mean much to them. So they're looking to defer the tax on that, and with our structure, we can do that. The only thing we can't do is we can't, once the proceeds are in the trust, we can't invest to buy them a personal residence. That's
Mm.
really important. So if you're selling your residence and you need to buy another one, you might need to take part of the proceeds, pay some tax on that, and then buy your personal residence. But we can get back into other types of investment real estate. One of the nice advantages of our structure is we can literally invest in anything. So that means, typically a diversified portfolio of, ETFs or stocks and bonds, whatever that seller is comfortable with. Remember, they have oversight. They're now the bank. So our structure is simply a specialized installment sale. Now that seller, we owe them the money, the trust owes them the money, and all the proceeds are in the trust from the sale. But because the seller hasn't received those proceeds, they're not paying tax yet. When we start to pay them, as we pay them, then they're going to start to pay tax. So we're not doing anything the IRS isn't familiar with, and that's really, really important when you're looking at tax strategies and structures and that kind of thing. We're taking advantage of the three things the IRS allows, which is deferral, right? We're deferring the tax, we're leveraging the growth in the trust, so we're letting that compound and build up so it's higher in the future, and we're timing when they take it out and pay the tax. So deferral, leverage, and timing are the things the IRS allows and the things that we're taking advantage of, which
Well,
are the things that wealthy
you
people
should
have always
change your
taken advantage
name to DLT, defer, leverage, and time it, just
of.
to
Right.
be different from a DST.
Right.
You can keep
Yeah.
that. I'll give you that one for free.
Awesome, awesome. I'll trademark that.
There you
But yeah, so
go.
it's it's nice because of the power of deferral. It's nice because of the compounding effect and the ability to time when you pay the tax. These are things that really build wealth and allow people to really take advantage of the tax code in a legal way.
Well, you mentioned the 250 and the 500,000 exclusions. So let's kind of start from there. So in case you don't know, if you're selling your property, if you're single, you automatically get a $250,000 exclusion. If you're married, you get a $500,000 exclusion, which is great, except we live here in Southern California, and luckily we are blessed with all kinds of equity that we've built over time. So one of the things I remember when you talked about, we kind of talked about there was a certain minimum that you probably need to have before your structure even makes sense. So before we get into what your structure is, kind of talk about like what your typical clients look like. Where do your services start to make sense for someone?
Great question. Yeah, we're typically looking for $1 million of taxable gain. So that means if it's a married couple, $1.5 million is the gain. $500,000 they're going to be used with their exclusion, and then there's another million that's taxable. In California, you're looking at 36, 37% is what you're giving up. And we've done some smaller deals, but that's really the minimum that we'd like to do. And so that's kind of the minimum that we like to look at.
All right, so yeah, so if you have 1.5 million, 500,000 they can exclude automatically. It's the $1 million or more that you guys are going to put through your DST structure. So, all right, let's say then we've sold the house and, someone wants to defer those gains. They're basically creating a trust, right? Like, and almost like it's another escrow company where the funds are going to be held. Talk about just the logistics of how the structure is, and more importantly, how the money flows through that structure.
Okay, great. Yeah, it's important to know that our structure needs to be in place before they close escrow. So ideally, when they've listed the house or they've at least found a buyer and they're starting a 30 to 90 day escrow, we need to get involved. Our law firm needs to draft that trust, and that trust needs to be in place before the deal closes. So essentially, what's happening is the law firm's creating a trust just for their transaction. And during escrow, technically what's happening, so you've found them a buyer, right? They've got the buyer, they're ready to pay for it. What's happening in escrow is technically the seller is selling it to the trust. And the trust and they're taking back a note. That's the installment sale. The trust owes them the money, but it doesn't have the money yet. The same escrow, the same day, everything happens all at once. The trust turns around and sells it to the ultimate buyer. And instead of, again, the seller receiving the proceeds and then they would pay tax, the proceeds go into the trust account. All of the money is there, and now all of those funds secure the note that's owed to the seller. So unlike a traditional installment sale where if I'm doing seller financing and I sell you my house and you're paying me, $100,000 a year for 5 years, the risk in that is that you call me in year 3 and say, you know what, the house wasn't worth $500,000. I'm not going to pay you the rest of the money. Right now, I got to chase after you and get involved with all that. In our case, all of the proceeds are there. You just haven't taken any of it yet. So that's why you don't pay tax. And the nice thing is the money that's owed to you by the trust is all there. The note is fully secured, right? It's the best type of loan. Now comes the fun time when you get to decide how much you want to take, how the money is invested.
I am the trustee of my trust, right? Like I
No.
own that trust,
No.
or is there
Nope.
a third party who's in charge of that trust?
Great question. No, you do not own the trust. That's actually our role. DST Advisors is the authorized trustee for the law firm. So we are the independent trustee, which is required, right? And so we own the trust, we own the asset, and we owe you the money. And that note is fully secured by the assets in the trust, and you are now the lender, right? We owe you the money. So you have complete oversight and approval on, number one, how the proceeds are invested. You design when and how much money you take. And we can get into all the cool advantages of that structure. But again, the reason you're not getting taxed is because you haven't received it yet. So what do you own now? You've gone from owning.
You're in charge of the trust, but I tell you what to do with that trust. I dedicate or dictate where those funds get invested and what type of return I want on those funds from the trust.
Actually, a little technical. You can't tell us what to do because the IRS says if you have direct control, then you've basically received the money and you're going to pay tax.
Got
What
it.
you have is you have lender oversight. So the proceeds come into the trust. We as the trustees don't want to invest it to our risk tolerance. We want to invest it to your risk tolerance. You're the ones we owe the money to. So what we typically do is we need to hire a financial advisor. A lot of times that's the client's financial advisor, which we love. So now we have an advisor that you know already, and they're going to ask you, what are you trying to achieve from this sale? When do you want to take money? How much risk are you comfortable taking? What's your timeline? How long do you want to spread this out? Based upon that, the financial advisor will put together an asset allocation. Typically, it's a diversified portfolio of stocks and bonds or ETFs or mutual funds. It might include some alternative investments. We can literally invest in anything. But we want that professional advisor to design the portfolio around what you're trying to accomplish. And so we're actually the client to the financial advisor. That's really important. You're the oversight. You're the lender looking at everything, approving everything. You're not technically making those decisions, but we want to do everything that you're comfortable with, right? So we designed the portfolio around your risk tolerance. We then implement it, and now you've gotten exactly what you want. And what happens is after the advisor puts together that asset allocation, they present it to the seller and to us, and they say, here's what we're thinking about investing in based upon the seller's goals, and here's the return we expect. It's not uncommon to get a 8 to 12% return with some of these advisors, more sophisticated advisors. So if we're going to get, let's say, an 8% return, which is pretty easy, we're going to set the note at, if the advisor says this portfolio is going to likely earn between 8 and 10%, we're going to set the note interest rate at 8%. We want to push as much of that interest to the seller. So remember, they're the bank, we owe them the money, and now we owe them, in that example, 8% interest on their money every year.
So let's say I had $1 million in the example we were starting to work with. $1 million gets invested. It's kicking off 80 grand a year. Basically, that's what my note is. I'll get paid. Is that monthly, quarterly? I can design it however I want. Is that how that works?
Yeah. So exactly. So so we either pay you the interest or it's accruing. Either way is fine. You don't have to take payment. Some people say, I don't need any money for 5 years. All right, great. Let's let that build up inside the trust and then start taking it. You're right. So that's exactly how we design the interest. Now the notes are 10-year notes because that's typically what a commercial bank would do, and we're always trying to mirror what a bank would do. So we have a 10-year note amortization schedule. In that example, we're paying 8% interest or accruing 8% interest. So unlike the Delaware, distinct difference, wow, I was only going to earn 4.5% in that, and they told me what I was going to earn. Inside that Delaware structure, that might be earning 19%.
Right.
But they're only giving you 4.5%. So in our structure, we've got this great flexibility to really earn whatever you're comfortable with, and we can literally invest in anything. So that's really, really cool. And again, the seller designs when and how much money they want to take, which is another very powerful point. Because not everybody needs money, and why would you take it and pay tax on it if you don't need it? Right?
And that's when I use it, right? So I'm then, if I, in that example, taking the 80 grand a year, I'm going to pay income taxes on the 80 grand a year, which is less than what my capital gain tax rate would be, or does it depend on my personal tax situation?
It depends on your tax situation, but you're right. So there's typically a couple different tax outcomes when we're making payments. One is that note interest. So that's typically taxed at ordinary income rates. If we're paying the seller more than the interest in any 1 year, then anything over that is getting divided up in between return of basis, where they're not paying any tax on that portion, and anything above that would be taxed at capital gains tax rates. So there can be three tax outcomes when they start receiving money. Or that, again, they might say, just pay me the interest for the first 5 years, and they're not paying any capital gains tax.
In the situation where I don't take money out and I'm letting the interest accrue, is there a situation where I'd pay, and again, let's use that $1 million example, where I'm having to pay taxes on more than $1 million because my investments have been successful? Or am I capped at paying taxes at $1 million, and anything above and beyond that it earns, I get that tax free?
Yeah, no, typically it's just going to be what you went in with originally. So again, you're earning interest like a bank would, so you're getting taxed on that. And if you're receiving more than that, you're paying tax on part of that, whatever the gain, percentage was. And so what's happening as we go along, this is important. So remember, there's an amortization schedule that spells out the payments and everything else and what we owe you each month. What we're doing each month as trustees, we're saying, okay, each month, how are the investments looking? So we're looking at the investments every month, and every calendar quarter, we're saying, hey, what do we owe you at the end of this calendar quarter on that schedule? Whether we're paying you or you're accruing, whatever it is, what do we owe you? And we're comparing that to what are the investments worth at that point in time? Because we want to see, is that note still fully secured, right? And inevitably what happens over a 10-year time horizon is there's going to be times where the investments are worth more than what we owe, and there's going to be some times where the investments might be worth a little bit less than what we owe. The good news is we're monitoring those investments, and if we're invested in something that's not working, we can change it anytime we want. So as markets change, we're going to reallocate that portfolio always with the note holder's approval and insight. Remember, we want to do what they're comfortable with, not us. So indirectly, they have oversight and they're really directing how the money is approved. Just technically, we're doing it. So that's really, really nice. They always know, hey, is my note fully secured? Is it not secured? How are the investments doing? Sometimes they'll call us and say, hey, I heard about a great opportunity I'd like you to consider investing in. They can't tell us what to do. We don't like emails like that because the IRS doesn't like it, but they can suggest something and we can invest in something they suggest in. It's our decision, but again, we want to do whatever they're comfortable with and whatever they're interested in. As trustees, we're always looking to make sure that we have the cash flow and the needs to pay them what we need to pay them every month. If we're making a payment to them for $10,000 a month, we need to make sure those investments are creating that cash flow. Had a great example of somebody selling a building in Arizona years ago for $59 million. Their basis was around $5 million. So huge tax bill. They were getting $35,000 a month from this apartment building, this big complex. I think it was 160 units or something. They were netting about $35,000 a month. Of course, they didn't pay tax on that big offer they got. They got an incredible offer that they couldn't turn down. We have been paying them $203,000 a month in payments since then. So think about the lifestyle change from $35K where you're hassling managing an apartment building to just getting a check every month. I love that story. Those are the best. But again, yeah. So they're designing it. They're telling us, how to structure this thing. We're just making sure that everything is legal, all the accounting is done, and that the investments are working. And quite frankly, sometimes they're working, sometimes they're not. But the beauty is typically we have, again, that 10-year time horizon, so we have plenty of time to fix things if they're not working. That's really, really important. What else do we have if we're invested in, marketable securities? We have liquidity.
Yeah, right.
We can liquidate anytime we want.
Any point in time you can do it and rebalance the entire portfolio. How do these usually wrap up? Like how do these, eventually in my $1 million example, I'm going to get all $1 million. Does that usually take 10 years or does it get extended over a longer period of time?
Great question. One of the nice things is it does offer that ongoing deferral. So some clients are done in 10 years, some are done in 5 years. But I would really tell most people, if you're not looking for at least a 7 to 10 year deferral, our structure probably isn't worth it. So typically what happens is the end of 10 years, the note is due. Now they're the bank, right? So they say to us at the end of the 10 years, hey Ben, we love the deferral, we don't need the money, let's do another 10-year note. So we're deferring for another 10-year period. They just keep doing that and defer decade by decade. That's part of the beauty is we have that option for ongoing deferral that you wouldn't have in a traditional installment sale. But that's what happens. Either that or we just pay them out. So they're going to get whatever we originally owed them plus any accrued interest that hasn't been paid. And that works nicely.
Well, at that point in time, I am paying taxes, but I'm now paying taxes on dollars 10 years from now, which with inflation are a lot less than what the dollars would be this year if I was to pay that capital gain tax.
Yep, so you get it. I mean, most of our business comes from wealth advisors because they understand the power of that growth and the power of discounted dollars in the future. So, wow, now I get the chance to earn a nice return for the next 10 years and pay with discounted dollars in the future. Well, that's ideal.
Well, good. Ben, that was really really informative. Thank you so much for coming on. I know we just scratched the surface of what this is, but hopefully it gave people a rough idea of how the structure works. And if they want more information, we're going to have your information down below, or just feel free to DM me and I'll get you connected to Ben. Ben, thank you so much for being on today.
Dave, thanks for having me. You're doing a great job. Love it.
Thank you. All right, everyone. Hey, thanks for watching. And if you haven't already, please hit the like button, subscribe button down below. We will continue to bring you more content. Thank you, Ben, and we'll see you next time.
All right. Bye-bye.